What's going on, guys? It's Stock Picks by Tim here, and I want to talk about a couple things. We are going to be getting into the new year very, very soon, and I wanted to talk about, will we see two consecutive bad years? It has happened before in the market. Four times. We've seen it in the Great Depression, we've seen it in World War, we've seen it in the dot-com bubble, and we saw it in the oil crisis in, I believe, the 70s. Besides a few sectors in the market, everything across the board is pretty much down. And if you ask someone, will the market be up or be down next year, you can get a variety of answers. And in the end, no one really knows. But one thing we do know in the end is the market will recover. And history has shown that during the worst years, if you were investing in good, high quality companies throughout that time, you would make outsized returns compared to just a typical year. Now, whether or not the market is up next year or we have another bad year, have a second consecutive year of pain, years from now we will be looking back and missing out on these times. Definitely seems hard to say now, and it's definitely hard to invest, when every time you put money in, it seems to be getting taken away. As compared to other years where you put money in, it seems like you can't lose it. But the market definitely has its ebbs and flows, and in the end, getting through this pain, remaining patient, remaining committed, remaining convicted, that will definitely pay off in the long term. But if you like these videos, guys, don't forget to like, subscribe, hit the notification bell, and let's check out a couple things on the chart.
Alright, my friends, now let's check out a couple of things. First off, we're going to look at a couple of these articles. I'll leave the links down below for you because I'm just going to brush through them real quick. And then we're going to look at the chart and I'll give you my expectations there. And this is just going off of the SPY. Now, what's the average return of the stock market? Well, the average return of the stock market over the long term is just above 10% as measured by the S&P 500. Over the past decade through to March 31 of 2022, its annualized performance was 14.5%. And down here you can see the 5, 10, 20, and 30-year return on the stock market. You'll see that over the average of the last 5 years at least, it's averaged 18.5%, which is definitely higher than the typical average. Over the 10-year, we've got a 16.5%, definitely higher than the average. When you look at the 20-year, we've got a little under 10%. And then the 30-year going from 92 to 2021, a 10.5%, right around the average 10% per year. And of course, inflation adjusted, this number is a bit lower. And one thing you'll see here, looking back, when we did have a negative year, the next year was typically a decently performing year, if not an outperforming year, as seen here by 2019, going from 2018, a negative return on average, to an almost 30% return, which definitely isn't a normal thing. And you'll see down here when we had a negative year in 2015, our 2016 year was close to a 10% year. So, you can argue that since we've had such a rough year this year, perhaps we're due for a decent year in 2023, but it is still possible we have a second negative year in a row. As I did say, it has happened throughout history. But through really, really rough times, we're talking Great Depression, we're talking World War II, we're talking the oil crisis, we're talking dot-com bubble. So just know that, typically we can expect an average 10% per year in the stock market, but this isn't always the case. However, history has shown that if you invested in the S&P during the bad years, it is more than made up for it in those good years. Now let's see something else here. The S&P 500 rarely dips 2 years in a row, but history says 2023 could bring even worse pain for stocks if they don't rebound from these losses. Now what's that mean? Well, the index rarely sees consecutive losing years, but when it does see those consecutive losing years, the second year is typically worse than the first. Now the S&P has dropped about 20% this year, and it says should stocks fail to rebound, investors may be in for a brutal 2023. In consecutive losing years, second year slides have always been deeper than the first. Now, are we going to see more than a 20% down year in 2023? I personally doubt it. I personally gotta say I doubt it. But there's definitely another article to check out here. Now, another interesting thing this article brings up is out of 11 US banks that were recently surveyed by Insider, less than half saw stocks rising in 2023. And specifically, Morgan Stanley and UBS expect stocks to go lower. Companies had year-end price targets going from either 4,500 on the S&P 500, which would be about a 12.5% gain from where we're at, or going down to 3,400, which is about a 15% loss. And UBS wrote in a note that history shows that growth and earnings continue to deteriorate into market troughs before financial conditions can ease materially. And just seeing how the current environment is, seeing that inflation is still an issue to tackle, seeing that the Fed does expect to continue to raise rates, we can at least see some pain in my eyes for sure in the beginning of 2023. That would just be my honest opinion, my educated guess. Of course, that doesn't have to play out that way, but if 2023 does end up at least part of it being a bad year, I would expect the first half to be the bad part. But I'm always curious about how you guys feel about the overall market. Let me know down below. Do you think 2023 is going to be a good year, or are we going to suffer another bad year like 2022? Now, I do want to pull up the S&P. This is the SPX. And you'll see that, just looking at the chart, you can expect us to continue in this downtrend. You would expect, right? Well, one thing that's definitely encouraging is you do see a bit of a head and shoulders here. Here's the head. Here's a shoulder. Here's another shoulder. Could we play that out? It's possible. But what else do we see here? Well, we also see a reverse head and shoulders. There's the head, there's the shoulder, there's the shoulder. We're kind of at a standstill here. So there's a bullish and a bearish indicator. One thing you want to watch here, you'll see the MACD is working on curling back upwards. On that successful curl up and a push, we might see a little bit of momentum and possibly see a break out of this descending resistance. I'm doubtful, but it's possible. And zooming into the 1 hour chart, you'll see that the MACD definitely looks more bullish. You'll see that the RSI looks more bullish going upwards. But you'll see on the chart that we are still under our EMAs, the 50, 100, and 200 specifically. Now, one thing that I expect the market to see before we do potentially rebound, or at least have a short-term rebound, is I do expect us to test our 2020 peak. This was in February of 2020, and the SPX was at almost 3,400. Now, recently we did dip here in October. We had our low point here on the SPX, and this was at around 3,500. Could we come back down here and break it and test these previous highs? I think that's the next thing the market needs to see before we can decide to either turn around or continue downwards. But of course, I remain an optimistic long-term buyer in my high conviction stocks. The overall market over time will recover, and as we saw, you can see an average of 10% in the market. Sometimes it's bad years, sometimes it's good years. One thing's for certain, those that invest through it come out richer over the long term. Thanks as always for watching, guys. I hope you had a good Christmas. Hopefully we wrap up this year on a good note, and we'll see how 2023 goes. Despite all the fear, despite all the pessimism, I'm extremely excited for the new year, despite what the short term may be. But thanks as always, guys. I appreciate you. Take it easy.